Retail traders are currently getting chewed up in a cycle of violent liquidation. Over the last week, sudden fakeouts have slowly bled portfolios dry. You take a long position, the market drops. You flip short, and it immediately spikes. Welcome to Crypto Whale Radar. If you want to stop guessing and start trading with institutional precision, you are in the right place. The recent drop to 69,000 hit a series of bearish targets with mathematical precision, movements that the majority of the market failed to anticipate. Traders are failing right now because they are applying macro strategies to micro timeframes. To survive the coming week, you need a specific blueprint designed to trade the range-bound trap we are currently locked inside. We have to start with the overarching headwinds. The S&P 500 continues its multi-week pullback, establishing a broader weakness in traditional markets that actively suppresses any sustained crypto breakouts. This split-screen chart illustrates the situation on the Bitcoin weekling in 3-day timeframes. Notice the price line trending upward on top, while the momentum indicator trends downward on the bottom. This creates a multi-week bearish divergence. A few minor short-term bounces over the last 48 hours do not cancel out a structural downtrend of this magnitude. The overarching bearish trend remains entirely intact. But we are currently facing a paradox. Despite the heavy macro weakness, the 3-day and 4-hour RSI indicators are hitting oversold levels. RSI stands for Relative Strength Index, a momentum metric used to measure the speed and magnitude of recent price changes. The last time we saw this specific technical alignment was in the middle of 2022. What followed was a brief, localized relief rally that lasted a few weeks before the broader downtrend resumed. An oversold signal inside a macro bearish trend does not mean the definitive bottom is in. It signals a deceptive, temporary relief bounce mathematically designed to trap overly eager buyers before the floor gives out again. Zooming into the 4-hour Bitcoin chart, we can see the price perfectly hit and bounced from our exact support target between 69,000 and 69,500. Market makers hunt liquidity pools, massive clusters of retail stop-loss orders. Recently, they drove price up to wipe out the upside liquidity above 72,000. Then, price reversed to wipe out the downside orders at 69,000. Both the ceiling and the floor have now been swept. The immediate consequence of these dual sweeps is a market board entirely cleared of easy liquidity. Without large clusters of orders acting as magnets to pull the price in a clear direction, the market enters a low momentum environment. It exhausts itself and chops sideways. Anyone trying to trade a massive directional breakout here will be violently slaughtered. For the next 24 to 48 hours, the battle lines are strictly defined. We have a hard floor of support at 69,000 and a heavy ceiling of resistance at 72,000. Do not attempt to trade a breakout right now. The strict tactical shift required to survive this environment is to trade the bounces within this established range, fading the extremes. Trading a low momentum range requires accounting for fee structures and order slippage, which can significantly erode the narrow margins of these specific setups. That is exactly why I execute these specific setups exclusively on BingX. It provides the high-precision environment and low-fee structure required to capture value from tight range-bound chop. I've placed a specific referral link to BingX below this video. Setting up your account through that link unlocks direct financial bonuses that you can apply directly to your margin. More importantly, using that link grants you access to my personal trade communication. You get real-time execution alerts straight from my desk. Having the correct market thesis is useless if you don't have the precise tools to capitalize on it. Surviving this trap requires professional-grade infrastructure. To understand the altcoin market, we look at Bitcoin dominance, a metric that tracks Bitcoin's market cap as a percentage of the total crypto market. Right now, it is moving entirely sideways, mathematically chaining altcoins to Bitcoin's choppy behavior. We can see this cascading effect clearly by shifting focus to the Ethereum 3-day and daily charts. This line chart maps out Ethereum's recent descent, specifically its failure to hold the golden pocket. The golden pocket is a critical Fibonacci retracement zone between 2,150 and 2,250, used to identify high-probability support. Ethereum is breaking below it. A confirmed daily candle close below 2,150 officially invalidates Ethereum's previous short-term breakout. The upward momentum is dead. Because of this breakdown, Ethereum now has to fight against a newly established lower resistance ceiling located between 2,200 and 2,400. Ethereum's failure to hold its golden pocket is the canary in the coal mine. When the second largest asset in the space breaks technical support, the rest of the altcoin market is immediately exposed to severe downside risk. Pivoting to XRP, we see a mathematically perfect rejection straight down from the $1.60 Fibonacci resistance level. XRP is currently clinging to a very fragile line of immediate defense, sitting at the $1.43 to $1.44 support level. If that support snaps, the exact bearish contingency target for XRP sits directly at $1.37. Over on Solana, the breakdown is already confirmed. We just saw a critical 4-hour candle close completely below the $88.70 mark. Dropping below that level transforms Solana's previous support zone into a hardened resistance wall spanning from $88.70 up to $90.70. Chainlink is showing the exact same exhaustion, currently trapped in a strict sideways box constrained between $7.90 and $10. Across the entire board, from Ethereum down to Chainlink, assets are pinned against heavy resistance or clinging to fragile support. Making aggressive directional bets in these conditions is a mathematically reckless move. The macro trend is heavy, the micro trend is exhausted, and the liquidity vacuum dictates a strict, non-directional range-bound environment. If you want to navigate this chop without liquidating your portfolio, hit the subscribe button for Crypto Whale Radar right now. Relying on delayed public Twitter updates will get you wrecked. Join our closed Telegram channel using the link below to get elite, real-time access to the data. This channel provides unvarnished market logic and actionable setups before the moves actually unfold. But trading this current range is only profitable if you know exactly where the institutional order blocks are hidden. Click the video on your screen right now to learn the specific order block strategy you need to survive the rest of the week. I'll see you there.